Hi all, good evening and welcome. I am Mehak Chavan from the Corporate Communication team, and on behalf of CareEdge, I welcome you to our today's discussion on steel short-term setback. Will it regain its luster? We sincerely appreciate your time in joining us for this webinar. Now may I request Mr. Padmanabh Bhagwat to take over the proceeding. Mr. Bhagwat is a Senior Director at CareEdge.
Thank you, Mehak. Good evening to all. On behalf of CareEdge, a very warm welcome to all for this webinar on steel industry. I would like to take this opportunity, and it's my pleasure to introduce our esteemed panel with whom we will discuss and get some insights on the current trends and the outlook of the steel industry. Our first guest today is Mr. Seshagiri Rao, Joint Managing Director and Group Chief Financial Officer at JSW Steel Limited. Mr. Rao is responsible for the overall operations of JSW Steel, including strategic formulation related to business development, expansion in existing businesses, joint ventures, mergers and acquisitions, and cost management. He has played an active role in the growth strategies at the JSW Group. Mr. Rao has a rich experience of over 3 decades in the steel sector and in areas of corporate finance and banking. Mr. Rao is a member of Institute of Cost and Works Accountants of India and an associate member of Institute of Company Secretaries of India. Our next guest is Mr. Amit Harlalka, Deputy Director and Deputy Chief Financial Officer at ArcelorMittal Nippon Steel India. Mr. Harlalka joined ArcelorMittal in 2005 as Financial and Project Controller of ArcelorMittal in Bosnia and went on to become Financial Controller of the group's Asia, Africa Mining and Stainless Steel segment based in Luxembourg. He has also served as CFO of ArcelorMittal Mexico and ArcelorMittal International. Mr. Harlalka has also led the financial planning and analysis function for ArcelorMittal's flat products division in Europe. He relocated to India in 2019 as General Manager of Strategic Projects, working on the acquisition of Essar Steel prior to his current appointment. Mr. Harlalka is a chartered accountant and holds an MBA in finance from the Indian Institute of Management, Bangalore. And our next guest is Mr. Rajib Guha. Mr. Rajib is a partner at Nithia Capital Resources Advisors LLP. Mr. Rajib has 20 years of experience in investment banking, capital markets, and mergers and acquisitions in various geographies around the world. Prior to Nithia, Mr. Rajib was Chief Investment Officer at Zamin Resources and also held senior positions at Royal Bank of Canada, Citibank London, and JM Morgan Stanley. Nithia Capital Resources is a global advisory and investment firm. The firm has a fund of around $500 million for investments in steel, power, and allied sectors. The firm, through its joint venture with Carlyle Investors, has acquired Uttam Galva Metallics and Uttam Value Steel, and also recently acquired Crest Steel and Power in India. Mr. Rajib is a CFA charter holder and has a master's degree in business administration. And the panel discussion will be moderated by Mr. Sachin Gupta, Executive Director and Chief Rating Officer at Care Ratings. He has over 22 years of experience in leadership positions across credit rating businesses. Prior to joining Care Ratings, Sachin worked at CRISIL as Senior Director and managed the corporate and infrastructure ratings. Let me begin on a positive note. If we look back, the last 2 decades, world has seen significant changes. However, if we have to look at the Indian steel industry, it has not only weathered the challenges, but also has adapted itself to the changing world dynamics. Last year was a rather remarkable year for the steel industry. Record production, robust demand, price cycle at its peak. With changing time, the situation changes as well, and when it comes to commodities, the change is fast and equally discourteous. Until the Russia-Ukraine conflict, post-COVID demand was picking well, economies indicated strong revival, and there was a strong optimism among all parties. However, New Year has come up with new challenges. World supply channels were disrupted, prices spiraled up to uncharted territories, and with rising inflationary pressures, central banks started tightening monetary policies. The growth outlook for most of the economies was lowered. This impacted the commodity prices, which started correcting sharply from their peaks. So after almost 2 years of a dream run for the steel industry, fears of interest rate hike, raw material prices, uncertainty in Chinese demand, and growth slowdown in the major economies have caused a short-term setback in the fortunes. Today's webinar will try to focus on how the sector is shaping itself in adapting to changes in the world economy, and we will also try to understand from the industry experts the capability of the industry to overcome these challenges. The key messages that I would like to share as takeaway from the webinar are: economic jitters to impact global demand in the short term. some of the economies may be staring at a recession. Global prices appear to have bottomed out. After the recent fall, the prices seems to be stabilizing. Structural changes globally in the nature of demand-supply dynamics and the cost of production will benefit Indian players. Duty imposition to impact export volumes, export duties which have been levied to control the inflationary pressures have resulted in India temporarily losing some market share in the export markets. With raw material prices rationalizing, the pressure on profitability margins is likely to ease in the second half of FY23. On this note, I would like to hand over to Hitesh Avchat, the sector expert and associate director at CareEdge, who will take us through the presentation on the steel industry. This will be followed by a panel discussion. We will be having a Q&A session with the audience at the end of the discussion. In case of queries, you are requested to key in your panel. Over to you, Hitesh.
Thank you, Mr. Bhagwat. Thank you for your opening remarks. Once again, I would like to welcome our esteemed panel members and to our participants for their interest. Currently, we see that the industry is at an inflection point. The post-COVID surge in demand, along with continued supply disruptions, had led a commodity price skyrocket. While the impact of the COVID situation has not subsided completely, the world again was hit with the Russia-Ukraine crisis. In the initial period, we witnessed that the prices actually moved up. However, with no end to the crisis, we see there in terms of the overall economic growth, we see the economic jitters started fading. What was also in addition to that is the kind of mixed signals being sent from the Chinese economy, which amplified the cynicism what the market was seeing over the last 3 to 4 months. The chain of events seems to be unstoppable, and the impact on the world economies rather seems to be more deeper and prolonged. So CARE presentation will be covering the current global scenario, followed by the movement in steel prices and the key raw material trends. We will share our domestic demand outlook and also the outlook which covers the overall view of CARE on the sector. So coming on to our first slide. As you can see, global steel capacity during the last decade or so has only grown. And if we look at the last decade or so, there is a net capacity addition of close to 270 million tons as far as the global capacity is concerned. And the overall global steel capacity has reached to the level of somewhere at around 2.5 billion tons per annum. As you can see in the chart, there has been a consistent increase, but if we look at the last 10 years CAGR, the increase in capacity, the CAGR is close to just 1%. However, world steel demand during the same period has actually grown at a CAGR of 2.8%. This has resulted in utilization rates moving up. Faster growth in steel demand in comparison to the steel capacity addition has resulted in a sharp fall in global idle capacity. If the global steel industry is operating at around 80%, then we are at a situation when capacity equals demand. Even in the 2008 crisis, there was 10% overhang of capacity as far as the operating rate are concerned at around 80%. So surely we are in a better place at this situation. But now when it comes to commodities, we also need to know how the Chinese industry is performing. Again, for the same period, if we are looking at the Chinese steel capacity addition, when I'm mentioning steel capacity addition, I'm mentioning about the net steel capacity addition. What we are looking at is a kind of a slower pace of capacity addition in the Chinese steel industry. Currently, the industry is pegged at around 1.1 billion tons per annum as far as the Chinese steel capacity is concerned. The point of interest is how much will it actually be able to export as compared to what it was doing earlier. Post the peak exports of close to around 100 million ton in 2016, the Chinese exports have witnessed a gradual slowdown. a clear shift towards being self-sufficient than being an export-oriented economy. Having said that, the Chinese economy has its own rules with its own pros and cons. Inflation remains low and the government has maintained its expansionary policy, which will likely be growth supportive. However, the underlying domestic demand is facing the heat from the weak property markets and also the slower pace of the manufacturing activity. If we see on the right side of the chart, in the last 2 months, the Chinese steel production has surely improved and so has their exports. But how the Chinese domestic demand will pan out is surely a question to understand. And we are looking at the two major steel consuming sector in the Chinese domestic market. The value-added construction and the industry both have heavily been dependent on the government stimulus in the past. This poses a threat on the overall sector outlook for the Chinese industry, which will be majorly government-driven than consumption-driven. While we see some recovery coming back in the Chinese market, the same will only be a fallout of another support from the government when it comes to the stimulus packages in targeting the economy moving towards the targeted GDP forecast of 5.5%. If we look at other global economies coming on to the other major steel consuming countries, we look that in the first 6 months of CY22, global steel production has actually declined. If we look at the percentage decline, it is close to 5%. If we are looking at the Chinese steel industry, which is accounting for around 55% of the world share, the decline is close to 6%. India is the only major country which has reported a positive growth in the first half of 2023. While Japan, South Korea, and USA have recorded a kind of a decline which is close to a 4% decline. If you look at the chart on the right side, the steel production activity has almost reached the pre-COVID levels. In fact, India, China, and Brazil has exceeded the production marks of 2019. Here we are actually comparing the first half of 2019, 20, 21, and 22. So bearing Ukraine, which has gone into a war, apart from that, most of the economies have performed well in terms of their 2019 production numbers. Russia, which is currently at war, also seems to have been unaffected in terms of steel production. But here, what we need to understand is Ukraine has been a kind of a net exporter of close to 15 million tons of steel annually, and this number is for CY21. And most of it was actually to the adjoining European nation. Now let's have a look in terms of how the global steel demand is panning out. There seems no immediate solution on the ongoing economic crisis. Global central banks are left with very limited options, but to increase the interest rates to tame down the inflationary effect. These measures are surely impacting the pace of the economy. While some estimates of the IMF suggest that inflationary cycle has peaked, continued supply disruptions and logistic constraint poses uncertainty for the world economy. The rising interest rate scenario is also impacting global sentiment when it comes to the manufacturing activity and future capex plans. The same is also being reflected in the PMI index as well, which although remains positive, it is indicating a subdued kind of a growth activity in the manufacturing sector. The pessimism in the global market is also getting reflected with the IMF latest forecast for April 22 as against the October 2021 forecast, which suggests the overall world economy and in fact all the major economies, there is a downward revision in terms of the estimates for the GDP forecast. CARE believes that the world steel demand may contract in 2023 mainly on account of the economic jitters which have been felt in the recent months. Now coming up to our price section, As you can clearly see in the chart, global prices have witnessed a rather significant correction in the last 3 months. Currently, the global prices are still hovering close to around $600 or $650 per ton. What we are looking at, the existing price, which is a decline of 50% almost from the peak, is still hovering much above the decadal average of around $550 per ton. So CARE believes that the global prices have mostly bottomed out at the current levels, taking into consideration the kind of cost of production steel manufacturers are looking at in the current scenario. Now let us have a look at the overall cost of production and how it is impacting the overall steel makers' profitability. As you can see, the chart itself actually is reflective in terms of the key trends in the movement of raw materials, which is basically iron ore and coking coal. What we are seeing is a clear kind of a pressure on the spreads which the steel makers have been enjoying. CARE views that the pressure on profitability margins will subside in the second half of FY23, which will likely be in terms of the correction in the raw material prices. Coming on to the India story, I will first take your attention to the recent impact of duty imposition to India's export trade. There seems to be an immediate impact, at least in the short term, on the exports volume for Indian manufacturers. While FY22 in itself was a kind of a benchmark year when India exported close to 18 million tons of steel, the first quarter of the new fiscal has been the witness in terms of slowdown in exports volume. Earlier, capex plans for large players have taken into account around 10 to 15% of exports volume. Now, will these calculations require a relook if the duty has to stay for a longer time? We will know more about our exports in terms of the panel discussion, but what past instances have shown that having more to say in terms of the duty, it is more short-lived than long-lasting. As far as the domestic demand is concerned, CARE forecasts that the domestic capacity would be increasing from around 151 million tons currently to around 180 million tons by the end of FY25, roughly an addition of 29 million tons into the Indian capacity basket. Demand, what we are looking at, is close to around a CAGR growth of 7%. So India will continue to consume additional 8 million tons of steel annually. As far as the outlook for the sector is concerned, CARE forecast in terms of prices, we have mentioned that in the second half of CY22, global steel prices are likely to hover around $630, $680. And we expect that iron ore prices will hover slightly below $100 per ton. But coking coal, which is more of a catching point, which still looks in terms of the overall average prices close to around $200 to $270. So in terms of overall demand, apart from the demand for finished steel or the carbon steel, alloy steel products have also been gaining a lot of growth. CARE expects the growth momentum in alloy steel products will continue the way what was seen in the last 2 or 3 years. As far as the overall deleveraging of the sector is concerned, surely last 2 years have seen higher cash flows from the operating activities, which has resulted in companies deleveraging themselves also while keeping in line their capex expansion plans. Overall, the bank's exposure to the sector has reduced close to around 40% from the peaks. However, what we are also observing is the overall kind of a funding which has been happening for the new capex activity in the domestic market is equally being funded through foreign debt. CARE considers the overall credit risk for the sector to remain fairly stable in the short to medium term period. As far as care rating is concerned, the key sector monitorables will be more in terms of how the global economic situation is panning out, and will there be any more or any further supply disruptions on the raw material front. Surely volatility in raw material prices is the talking point. As far as the sectors driving the demand growth, apart from the infrastructure sector in the domestic market, what we are also looking at is a robust demand from the automobile activity and also the pipe manufacturing companies. In terms of color coated, in terms of value added product, the demand for color coated products also continue to remain robust. As far as the regulatory changes are concerned, we are monitoring the kind of activity in terms of government actions with respect to the duties, whether it is the export duty on finished products or whether it is the import duties on key raw material products, which have now come down to zero. But these will continue to remain as a monitorable. Also on the regulatory front, what we are looking is in terms of any changes in the mining activities and in the royalty frame. Apart from that, the ESG targets will also be monitored. With this, I would like to end the presentation and I will like to hand it over to Sachin for the panel discussion. Over to you, Sachin.
Thank you, Hitesh. Thanks a lot for a detailed and a fairly comprehensive presentation. I'm very happy to moderate this panel, and I'm very proud to say that we have fairly strong panel with leading industry experts with us today. Padma Bhagwat already introduced our panel. So we have Mr. Seshagiri Rao from JSW, Mr. Amit Harlalka from ArcelorMittal Nippon Steel, and Mr. Rajib Guha from Nithia Capital. So I think the context has been set, pretty much. If I were to just in broadly in two sentences kind of summarize, what Hitesh kind of explained in detail, that last 1 to 2 years have been pretty much a roller coaster for the steel industry. I think we were seeing a never before prices till a few quarters back. There was a strong demand momentum. And now we find ourselves in the mid of significantly moderated prices and also a question mark on the robustness of demand, especially in the global context. Also because the large economies of US, Europe, China, I mean, people are talking about recession, if not, or a very low level of growth. In addition to that, the currency is volatile. The exchange rates are also kind of, especially rupee to US dollar is kind of quite, moving adversely. So in all that backdrop, we really have kind of few large questions, and we will kind of put it to our esteemed panel. First, question I would like to put to Mr. Seshagiri Rao, and that is in terms of price. Everyone understands is volatile, and I remember your commentary even earlier when the prices were ruling at a fairly high level. You always said that the prices will correct because this is an unsustainable level. So to that extent, I think market was expecting the prices to correct. The bigger question is on the demand side, and especially on the domestic demand, because in the current context, since exports are anyways a little muted. So how do you see the domestic demand kind of playing out? And if you can give a flavor both on the flats and the longs, that will be helpful, sir.
Sure. So good afternoon to everybody. So as the presentation described, there is a huge amount of volatility in the context of Ukraine and Russian war in the steel sector, both from the demand and supply point of view, and also from the fall in prices. But what we have been observing in the last quarter and also in the month of July is that entire month of May and June, the expectation of the user industry is the prices would fall. So with that expectation, the apparent steel consumption was lower, but the real consumption has not come down. Why I am saying so is that if you see today, the last 1 or 2 weeks, the inventories that are there in the retail segment, that is distributors, or with the user industry, has come down. So during this period of 2 months, that is May and June, majorly they destock the inventory with the expectation that the prices will fall. They don't want to carry the high cost inventory. So with that, the inventories have gone up with the producers instead of with the user industry. But for the last 2 weeks, in the long product side, definitely we have seen a traction where inquiries have increased. You must have seen even prices for long products are looking up. They have gone up, in fact, in the last 2 weeks relative to what it was. So the demand for long products have already come back. And at the same time, as far as flat is concerned, we are not seeing that type of traction as we have seen in the long, in the flat. But in the flat side, the user industries, if you classify and look at automotive has never come down even in the last quarter. So we are seeing a little bit of acceleration, the offtake from the auto sector. Similarly, the packaging and the machinery and capital goods sector is doing reasonably well. And the structural steel from the infrastructure side, that also coming back. So we feel that now, at least the psychological feeling is the prices are stabilized. It is not going to come down. Therefore, we should start at least make inquiries. So in the flat products, it is an inquiry stage. In the long products, already it is converted into orders. So in my view, it is a matter of time, at least in India, the demand coming back. And in this year, we are very hopeful that the demand growth will be at least to the extent of 7% over last year of 105 million tons.
Got it. Got it. Thanks a lot, sir. Thank you. Next question is to Amit, and especially with your, global experience across various geographies and including Europe and other places. What is your sense on the, again, on the demand side at the global level? Because in some ways, we saw, the global supply demand situation will have a bearing on the Indian, both on the prices and on the export possibility as well. So what's your sense on the global steel demand?
Thank you, Sachin. Thank you, everyone. In terms of demand, what we are seeing across the globe is, as presented by Hitesh, the first half of this year, the production was 5.5% lower than last year. The war in Ukraine and Russia, between Russia and Ukraine, has resulted in elevated energy prices across the globe, which has resulted in very high elevated inflation level, resulting in higher interest cost. So across the globe, you see this phenomena of higher energy cost, higher inflation, and higher interest cost, resulting in pressure for the steel demand and overall as an infrastructure demand for steel. So we see that challenge remains across various geographies. And in Q2, which is April to June quarter, we also saw the resurgence of COVID in China, resulting in lockdown and they being more into a mode of exporting of steel than domestic consumption, resulting in lower prices globally. Europe, because of the higher elevated energy prices and power cost, there is a demand shock there. There's a reduction in demand. And we see that fairly across most of the developed countries right now. And as Mr. Rao mentioned, India remains a pool which is more robust in terms of demand right now compared to what we see globally. And we have to see how this pans out. The energy prices needs to cool down and the inflation levels have to come down for real apparent steel demand to really come back to a positive level versus what we are witnessing right now.
Got it. So yeah, so it's clearly in some ways a tale of two cities, as I'm hearing from Mr. Rao about the domestic side and from Amit about the global. So global still issues on the demand side, and while somewhere it, to my mind, does mean that the prices could also be impacted, at least the global prices for the various products. Rajib, let me get you in here. All of us know steel is a notoriously cyclical sector. And we saw a fantastic a bull run or a highs during the last couple of years, and now we are seeing as we discussed and as the presentation showed in terms of the prices kind of coming down. So if we were to focus on the prices per se and more from a global perspective, not so much only for India, are we seeing the question is it like the beginning of a long-term downward trend, or is it like a blip in a super cycle which we were seeing for the last 2 years?
Good evening, everyone. Sachin, I think the main thing about steel industry that everyone should remember is that it's cyclical in nature. So the move in EBITDA margins as such is a function of cycle. I think over a short to medium term, and again, one has to remember that the entire cycle, steel cycle, which earlier used to be 6-7 years, have now reduced dramatically. So it's more like 18 to 24 month kind of cycle. I think we will be back to the normal margin as such globally. So, for example, in Europe, I think we will be in that 3 to 8% margin, whereas in US, it would be more like 10 to 14%. Whereas at the same time, when you look at emerging market, one would be back to 12 to 20% kind of margin. I mean, because margin is a function of both price and cost. So the rationalization in magnitude, that's the quantity or the EBITDA per ton, that people talks about, will reduce probably significantly from the highs of, what people have seen. But I think we would be back to stable EBITDA margin kind of scenario, and like and margin level will probably change based on input prices.
Got it. Mr. Rao, the export duty was very clearly a big dampener, and it in some ways came as a surprise, because in general, we are talking about Make in India, and there's a full focus, and this is one product which, while originally, or I would say traditionally, we've not been big exporters, but over the last few years, the industry players got it up to that level of quality, etc., and started exporting in a big way. So the question that I really have, while we can debate export duty will be removed, when will it be removed, the question is, how critical is the export market for us? Is it because right now, I think Hitesh mentioned about 18 million tons, and that was the best ever. So that's like about 7-8% of the overall market. Is it? And then another number that he mentioned is that every year our demand goes up by about 8 million tons, or roughly that's the number we're talking about. So is this 18 million ton of, say, the best export demand, is this very critical? So how important is it? Your thoughts, sir?
So the way somebody has to understand the export criticality to India is not at the macro level of 15-20 million tons. If exports don't happen, whether it can be absorbed in the domestic market or not. We have to go into details of what is the profile of exports, what kind of exports India is doing. Is it semis? Is it long products? Is it flat products? If it is flat products, what type of flat products are getting exported? If you see the profile, 80% of the India's exports at all times is flat products. So why flat products required to be exported? Why it cannot be made in India? The capacity, if you look at it, either cold roll coils, galvanized coils, or color coated, these are all additional capacities that have been created in India, not only to meet domestic demand, but also to export. That is why the profile of exports is majorly flat. It is not long products nor the semis. So in that context, criticality of export duty or exports to India is very, very important. So if export duty is imposed, automatically the exports won't happen. There will be more supply of steel in India. Therefore, the prices will fall. I don't agree with that concept at all, because we are not able to really continue the production. Because Indian domestic demand cannot absorb this. If we don't absorb, if we continue to produce, the outcome is inventory pile up at the user industry, at the producer level. So that is the issue here. So therefore, the additional capacities which are getting created, or in future when it gets created, it is more in the flat product side and value added side. Government of India, contrary to export duty, they also introduced PLI scheme for specialty steel. What does it mean? You have to create specialty steel capacities in India, not only to substitute imports, but also to enable the steel industry to meet growing global demand. So that's the reason why there are so many applications which have gone not only from current incumbents, even others, to invest more and create these specialty steels in India to substitute imports and also to export to the global markets. So I think in that context, if I look at it, is very, very important that this export duty is removed as early as possible. And at the same time, one more important point which I have been making out is that what India has lost because of export duty is a gain for China. Instead of looking at the macro number, H1 to H1 or quarter 1 to quarter of last year on year basis, the production has come down and the exports have come down. That is not the way I look at it. If you see quarter on quarter, the domestic steel consumption quarter 4 of last year versus quarter 1 of this year has come down by 4.5%. It has not gone up. If you look at year-on-year number, everybody feels that domestic consumption has gone up, which is not so. Q4 versus Q1, there is actually lower consumption in India. Our exports have fallen by 26% as far as India is concerned. What happened to China? Who took this opportunity? If you look at China, quarter 1 and quarter 2, if you compare, quarter 2 of the calendar year in China, the production went up by 16.5%. Production has not come down in China. Production has gone up in the Q2, whereas India has come down by 1.7%. At the same time, if you look at exports from China, that has gone up by 54%. They exported 13 million tons in the quarter 1. In the quarter 2, they exported 20 million tons, whereas India's exports fallen by 26%. So what India has lost, China has gained. So this is the time where there is a big opportunity for India to export more, particularly flat and value-added steel, and then take this opportunity. But unfortunately, we lost that. China has gained. If it continues for more time, I think we lose the markets. So therefore, it is very, very critical for India to review the current export duty.
Got it, sir. I think very well explained. Also, I mean, a quick follow-up. What is your, I mean, I know obviously you would expect it to be removed as of yesterday, but what is your fair sense by when do you think this will, a rational view on when this may be removed?
So one more unfortunate thing is if you look at the WPI numbers that have been released by the government of India, it is showing there is an increase in inflation in the steel, particularly HR coil. But if I look at the steel mint numbers of June 2021 versus June 2022, there is minus 7.6%. So Indian steel prices have come down June 21 versus June 22. But WPI numbers are not showing that. It is showing there an increase. So there is some lag in the numbers also on which the government of India is reviewing. It is important correct numbers are seen and then proper view is taken on the export duty. But whether when it will be removed is anybody's guess. But all the information is being provided by the industry to the government of India. We are hopeful that they will take these facts into account and take a call on this.
Got it. Amit, Mr. Rao mentioned about China, how they are kind of eating up into the space vacated by India. And you also mentioned earlier that China is kind of increasing they're exporting more. Overall, if you see, because, in China, there have been a lot of conflicting things. One, Shanghai was closed, and then we said, a lot of industry was not supplying. Now we are hearing, obviously, things are opening up there. And then, the supply, the export, which we spoke about, is increasing. What is your view? Because it's like 110 or 120 million ton kind of a thing, billion, out of the 250 that we saw, right? So roughly about 40% of the capacity, 1,100 or so out of 2,500 million tons. So in that 45, so it's basically the big daddy. So, and obviously India market will kind of really be dependent on there. So how do you crystal gaze there in terms of China impacting the Indian markets, both on the price and on the supply side?
So China, as you said, Sachin, is big part of the entire steel supply chain globally, and any export volumes or demand reduction has an impact on international prices. And steel being an international commodity, the price moves across every countries and region. So China definitely has a very important role to play in this. in this pricing. I would add to what Mr. Rao mentioned in terms of India. India has a very specific advantage in terms of steel versus China going forward. We have good resources of iron ore. India has been having a long history of steel making. India is blessed with renewable energy going forward. We need to really ensure that we capitalize as a country on all these critical items and the manpower resources which are required for steel manufacturing to really leapfrog in terms of steel manufacturing in India. And we have a great opportunity there. And in this whole opportunity, if you see the way steel capacity comes up, it's lumpy. It's 3 million tons, 5 million tons. And during that time, the domestic demand catches up on a gradual basis, 8%, 5%, 10% every year. So you would need access to export markets to really ensure that your capacities which are coming up have a good export market. And once you are able to fulfill the domestic requirement, you bring in new capacities, and those new capacities would require further exports. So it's a cyclical thing if you see in terms of capacities being brought in operation and then the export market. And India, I think, needs to, as we move forward, we have become more and more sustainable as a steel industry. If you see our trade numbers, we are now net exporter of steel. And I think we have a great opportunity moving forward in this journey. So I would say that compared to what we see in the rest of the world, India really stands out in terms of global steel capacity addition in the next decade. And we should really do everything possible as industry and as government of India to ensure that this journey is more smooth. There will be lumps in between, but this journey is more smooth and it allows the value creation and the employment generation as a country.
Got it. Rajib, normally we are kind of right now talking about, large integrated steel players. Can you give us, throw some light on the, the mid-sized players, especially, in this whole export kind of pretty much reducing? How will it impact them in terms of their profitability, their margins?
I mean, Sachin, actually, this answer is okay. So from a mid-sized player perspective, I think anyone in India is in India for India's latent demand. And like India is the only secular growth story in steel. Nowhere else in the world would we expect that. And that is reflective in the operating margins here. As a mid-sized player, I think demand contraction, expansion, shocks and all, they do happen. They do impact price levels. But for a mid-sized player, these are price events, not let's say production or supply events. So, I mean, any mid-sized player is able to supply and cater to the necessary requirements of their own customer, right? Of course, margins do take a hit. Demand factor, export issues are one for volume players, right? And such hits are a loss to the country, as Mr. Rao explained. I mean, China is benefiting at cost of India, but from a simple producer's perspective, and specifically for a player like us, who's literally in the center of India, we've never been a export-oriented unit. But in my opinion, mid-sized players are able to cater to the basic demand of the country, unless you have specifically set units only for purpose of export. As he himself Mr. Rao highlighted that there are these additional facilities and schemes which were brought in by the government to actually incentivize people to export.
Got it. Got it. Mr. Rao, one fallout which, the market is kind of fearing is that there was a lot of expansion plans which were announced by, many players. And that was the long-term story, when the margins were as high as they were and the demand was also robust both in India and globally. Now, with whatever correction we've seen, what is your take on that? Could there be a rethink and maybe a little bit of a pause?
No, as all the panelists have said, it is the India is the growth story. So even though there are some blips because of this geopolitical event and also reactions which have happened to the government by way of export duty, but the growth story structurally is not changing as far as India is concerned. So I don't think any of the players, particularly large players, are looking at scaling down the growth capex. So it is as per originally planned. Because India's overall size of GDP is expected to be 10 times in the next 25 years' time, or even more. So if that is the growth story for India, we need infrastructure, we need construction for real estates and all that. So the demand for steel continues to be there in India. I think next 25 years, I have no doubt in my mind that the size of the steel sector itself has to grow much faster than what we are growing right now. So this, I feel, is only a temporary blip.
Got it. Amit, coming to the more the ESG perspective, right? I mean, that is again, steel is fairly intensive in terms of resource consumption and emissions, etc. And then there is this whole talk about green hydrogen or a green steel being produced using green hydrogen. Now, these conversations are happening now in the current context. Obviously, ESG is a big thing across the globe, and especially in Western markets, Europe and US. Is that something that we will see in the short term, the changing, or at least some plants coming up which are manufacturing green steel in the country in any big way?
So in India, if you see from a green steel perspective, I think this journey for all global players and Indian players is going to be long. It's a capital intensive journey, and it's also going to be very interesting and innovative journey. So all of us as steel manufacturers have to understand and use new technologies to make them more cost efficient and use this in the whole process. So India as a country is quite a remarkable place in terms of renewable energy. And with this renewable energy now, which is green energy, we can transform the green energy to green hydrogen and eventually to green steel. But the journey is going to be long, because today the cost of green hydrogen is a deterrent in this direction. New innovations, new technologies will come in place, which will allow the country or us as a steel manufacturers to move into that direction. In addition to green hydrogen, I would say scrap-based electric arc furnace run on green energy would be the second model in which the journey will evolve. So that's another area where things will evolve as we move forward. In India right now, the incentive for a customer to pay a higher price for green steel is not there compared to what we see in some parts of the globe. So there should be an incentive for green steel, which will come in gradually. And this would allow the transition from the current traditional steel making to green steel. But it's a long journey, I would say, and it would take its own course in terms of next few decades.
Got it. Thanks a lot. Thanks, Mr. Rao, Rajib, and Amit. Now, what we will do is we will request our audience to punch in their questions, and then we will, give them an opportunity to ask their questions. All the audience, they are requested, if they have any questions, please punch in. In the meanwhile, I have already a few questions which have come, and I'll kind of take one of them to start with. Maybe Mr. Rao, if you can respond on this. The question is, sir, your take on the PLI scheme for specialty steel, whether it will create demand in the market in the long run. It's more on the specialty steel. I think you did mention about it, but I think if you can elaborate a bit more, sir.
No, the PLI scheme has been designed by the government in consultation with the industry. They identified what are the imports that are happening currently and what is the growth potential in India, and also what is the probability of exports of those particular items. Accordingly, the scheme has been designed. So therefore, it is very, very important for the industry to respond in line with the announcement by the Government of India asking for interest from the industry. There are several applications which have gone. They are being examined. In my view, there is large investments which will come in response to PLI scheme to produce specialty steel in India.
Right. Next question is, Amit, if you can take this. It is that now that we see a clear 45% export duty on pellets, most of the merchant pellets manufacturing plants might turn unviable. Are we seeing a situation wherein some of this capacity is up for sale given the unviability, and will, it says, and will you be interested in such plants? But you don't have to comment on that, your interest. But maybe, in general, how do you see it panning out?
So the sudden move by the government of India to put 45% export duty on pellet has completely changed the dynamics of the pellet business. So the merchant pellet business is no longer viable right now. Post the imposition of this duty, there is no export of pellets which has happened from India. Pellet production remains for captive usage, and at AMNS we have big pellet operations in Odisha and Vizag, and we continue to use them for our captive consumption. As and when any opportunities for pellets come up, I think the industry would all be looking at such assets going forward.
Okay, one more question, and Amit, if you can take this as well, which says how much capital it might take for the transition towards green steel for a normal player. I think you did mention about it being a capital intensive. So any ballparks, any benchmarks that you can share?
So Sachin, I would hazard a guess on this, but I would say the capital intensity for conversion from a traditional steel to a green steel would be significant, and it would run into billions of dollars, I would say, for a big company like ours, ArcelorMittal. So it's going to be very capital intensive, and new technologies as and when they evolve would really help to transition this in a most capital efficient way.
Got it. This is another question, I think, which we have discussed already. It says, given the rising interest rate scenario, and if the duty imposition stays for a longer duration, will there be a serious relook at the capacity expansion plan? So Mr. Rao had shared his thoughts. Amit, if you want to add to what Mr. Rao mentioned, basically they're saying, your hurdle rates will be higher, your profits will be lower. So would there be a serious relook?
No, the hurdle rate would be higher because of higher interest rates and also because of the export duty. But India remains a secular story for steel growth and steel consumption. So we continue with our expansion program and our long-term strategy for India.
Got it. Okay, we've got this is I don't know if anyone will. What will be the price movement of alloy steel in near future? Mr. Rao, will you take this?
Alloy steel, if you see, even when the prices were falling, the price of for alloy steel has not fallen that much. So margins are also have not gone up in the alloy steel sector. So therefore, the volatility is lower in the case of alloy steel. So that would remain even going forward in future.
Yeah. Okay. Okay. One question is this on the coking coal. You know that raw material prices, especially coking coal, was one of the party spoilers. How do you see it moving forward? Maybe Rajib, you want to take a guess on coking coal prices?
I think the slide that you guys shared, and if I'm not wrong, you gave a expectation of 180 to 220 for
200 to 220 to 270 is what.
No, that's for this year, and I think for next year is 180 to 220.
Yeah.
So, I see long term. I mean, all mining are more of a fixed margin play, albeit there are some cyclical changes. So, in my view, if energy prices remains elevated, that kind of level is warranted, because one has to remember that in mining, and coking coal mining is a seriously expensive mining, right? So that at that margin, I think most of the coking coal mines are going to be going to be decently profitable. I mean, if energy price is correct, and then people are talking about energy prices because of this shock going down to $70, that level might move down. But again, at the same time, if energy prices go up, that price level will go up. So I think the single biggest factor today, which is impacting coking coal prices, are actually the energy prices, because I think the price rationalization due to the sudden fall has already happened.
Okay, got it. Mr. Rao, next question, if you can take this. It says, what is your view on the EBITDA per ton for HRCs for the current year and the next?
EBITDA per ton is very difficult to say how much it would be, particularly in the steel sector, where there is volatility in the both raw material prices and also steel prices.
Correct.
But a converter where iron ore is bought, coal is bought, and steel is sold. So the margins, in my view, will get normalized, because there is always a lag between raw material prices and the steel prices. When steel prices go up, raw material prices will lag, and after 2 months it will get corrected. So this time steel prices fallen, whereas raw material prices are falling little later. That is why there is a problem on the margins. So 1 quarter after, I think it gets normalized, particularly for converters. Whereas integrated players, they make less money when the steel prices fall and their cost will remain. It depends on company to company what is the extent of integration.
Correct.
Based on that, I think the margins will come in, but normal margins will be there in the next 1 or 2 quarters time.
Okay. Amit, there's another follow-up question. We spoke about the pellet plants being unviable after the export duty. Now it says continuation to this unviable. Any specific outlook on sponge iron standalone businesses?
I would not be able to comment on this, Sanjay.
Okay, that's fine. Anyone else on the panel? Mr. Rao, would you have a view?
Sponge iron is basically a substitute for scrap. So it depends on scrap prices. So therefore, it moves in line with the scrap price.
Got it. Okay, I think that's... Now there are some questions which are company specific, which I will avoid. Okay. Okay, one interesting one. I will just take this as the last question. While there are a few more, but I will just take this thing. It says, how do you look at the upcoming threats from the substitute products such as glass, fiber, reinforced polymer? Even the government of India is getting vocal on the same. I've not heard of it, so my ignorance. If any of you can comment on this, it seemed interesting. Mr. Rao, you have a sense on this? Glass reinforced polymer, glass reinforced polymer?
No, substituting steel with any of the other products is very difficult. The total consumption of steel is 1.8 billion tons. And its unique features, so it's very difficult for other products to compete, either in terms of cost or in terms of features. Therefore, this debate goes on, sometimes aluminum, sometimes fiber, sometimes something else. But in terms of either decarbonization and the carbon emission point of view, or the cost point of view, otherwise unique strengths of steel point of view, it is very difficult for alternate products to substitute steel. It's not possible.
Got it. Great. So I think we're just on the dot 5 o'clock. So we are kind of good time for us to close. Broadly, if I were to summarize, what the big messages that we are taking away from this session is that the prices seem to be stabilizing in the domestic market. There is a bit of an uptick on the demand again in the domestic market, especially on the long side. As we discussed, flat is more at the inquiry stage, but yes, that is the expectation is that should also pick up. Global demand is where the I would say the threats and the risks still remain, especially in Europe market. Export duty is something. Exports are quite critical for us as an Indian economy, for us to kind of export it and get that full value addition of the iron ore that we as a country have. And that is where the expectation is that the duties should be in the long term, or rather in the short term itself, should be removed and make the industry viable on a global platform. China is in some ways I would say continues to be the big daddy here, and how it will play out, especially in the whole backdrop of the COVID, etc., remains to be seen, and we will have to be mindful of how that impact happens. Overall, as Hitesh had mentioned, the outlook from CARE also is reasonably stable, as the leverage of the industry has come down on the back of the profits that most of the companies made in the last 2-3 years. And on back of that, even though the expansions plans, as Mr. Rao said, will continue to be on stream, but the credit outlook as of now remains stable on the sector. I will give it back to Mehak for closing.
Thank you. Thank you again to all our guest speakers for their insightful views. It was a privilege to host you. Thank you to all the participants for taking their time out to attend this CareEdge webinar. Well, for any other further queries, feedback, or suggestions, please write to us at corp.com, com with double M, at careedge.in. Goodbye for now. I request the tech team to log off.
Great. Thank you, sir. Thanks, everyone.
Thank you.
Thank you.